Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from Charts and Markets runs down the major markets. He looks at whether the current rally will continue. He also takes a look at gold, silver, crude, and the U.S. and Canadian dollars. He has a special offer for our listeners. Longtime BC trader Victor Adair gives us his take on currencies, gold, oil, and discusses the common denominator threading through a number of sectors. Author of the second edition of When the Bubble Burst, Surviving the Canadian Real Estate Crash, Hilliard MacBeth, tells us the U.S. is the only economy showing any strength right now. He believes a 10% drop in the value of Canadian real estate is a modest estimate. He says the crisis rocking China's real estate market could easily reach across the Pacific. We'll talk to Ross Clark right after this.
Recyclico, making lithium-ion last forever. Recyclico's patented recycling process achieves up to 100% recovery of battery metals from lithium-ion batteries for electric vehicles, including cobalt, lithium, nickel, manganese, and aluminum. Recyclico Battery Materials Incorporated trades on the TSX Venture AMY, on the OTCQB AMYZF, and Frankfurt ID4. For more information, visit recyclico.com or phone us at 778-574-4444. Recyclico, making lithium-ion last forever.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on X at Charts by Ross. Welcome back to the show.
Always a pleasure, Jim.
How would you describe what happened on the markets this shortened trading week?
Well, I would say quiet. Volumes were definitely lighter than usual. When you get a 3.5-day week, it's a sort of a half day on Wednesday and a non-day on Thursday and a half day on Friday. The smart people just take off and make it a 4-day weekend. The markets as a whole, though, showed buoyancy. I mean, we've had just exceptional price action when you look at the number of consecutive higher lows or higher closes that we've had since the turn of the month there at the end of October. So just been a phenomenal run so far. But, you only feel that it's different this time because we've been going through that choppy phase since last June. But the action that we're seeing right now is not atypical for what you see coming out of the seasonal lows. In most years, you get strength like this that carries you in particular through the Thanksgiving weekend. And at some point now, within the next 2 weeks, expect to see a little bit of a pause. Could be a minor correction, but at least a bit of a pause. And if we get some oversold readings, then that becomes the catalyst then for the Santa Claus rally. And, as we know, that one has got a pretty good track record. When you go back probably 3/4 of the years, you can see a nice rally in that last couple of weeks of December that will carry you into January. And as January goes, so goes the year. So at this point, the strength has been good. Leadership, which had gone through a bit of a rotation, we are seeing things like the technology stocks come back into their own again. The XLK had been at multi-month lows at the end of October, going all the way back to May, and you're now at all-time highs as of this week. So that rotation's been going on. And even with some of the big stocks like NVIDIA taking a bit of a breather at the end of the week, and you've got the business with Sam Altman and then and the AI fiasco that's gone on, getting fired, going to Microsoft, and then coming back. A lot of talk around there, but in reality, the sector is still doing exceptionally well. So looking at the NASDAQ, the triple Qs, wouldn't be at all surprised between here and the end of the year that tack on another 4 to 5%. When you look at the consolidation pattern that we've come out of, there's lots of potential here.
What's going on with gold and silver?
Finally, we've been playing against resistance levels, and finally saw the gold price manage to push through the 2,000 level at the end of the week and hold it. We've been up here a few times this year on the spot price. Back in October, sort of kissed above and back down. We've been to 2,000, down to 1940, and now we're up. This is now the best level, the best closing level that we've seen since May. And in silver, same type of a reaction there. Closed up at 24.33. Haven't seen action like this in quite a while. These things, both the precious metals appear poised for pretty good runs. The cycles are a little bit tired right here, but the price patterns are good. So any follow through on the upside, and I think you've got a chance for a pretty good run. When I look at any time that gold has had a good oversold reading in the last 10 weeks of the year, and in our case, that was just 2 weeks ago, there's been an exceptionally reliable move that's carried us into the following year. We've got some good price and time counts as far as that's concerned, and put them out in a research report earlier this week. So, for all that we've been looking for a broad pattern to break out, looks as though we're getting much, much closer to the action on the upside.
What's going on with crude?
Crude oil is been under pressure this week. We haven't seen anything really in terms of any decent upside action. It's been peaking in the last couple of weeks here, progressively lower levels. We had highs up around 79.5 a week and a half ago. Then this week you're looking at 78, but we're down overall from what would be the seasonal high, normally at least a seasonal high in September. That you, from a seasonal perspective, would be looking for a November, December low, and as of this Friday, the sequential count that we look at, the weekly, has 8 weeks in its count. 9 is the optimum from which you would be looking for a potential turn. And historically, we've got 15 years when I look back where one of these sequentials has occurred around this November, December timeframe and staged a nice rally into the following year. You got 10 years of the last 20 that haven't even needed to get oversold. They were already in uptrends and then came to life. But this one, in a downtrend, we were at $95 not that long ago, at the end of September, early October, and here we are in 75 at the end of this week. So pretty good drop. And, there's always the fundamentals behind it. But for me, it's a matter of reading the charts. And this one, I would suggest that be looking for some bottoming action next week, and any reversal to the upside at all during December should have some pretty good legs in it.
Anything new on the chocolate and orange juice front?
Well, both of those are staying strong. It's going to be an expensive Christmas for those who are looking for their Purdy's chocolates here in Canada. We're at the highest levels that I've seen in cocoa in, I was going to say decades, but actually my data goes back into the 1970s, and I don't see any numbers like this. In orange juice, we know at $4 and higher is excessive, and that would typically would be looking for a reversal off a December-January high, and a pretty good breakdown into the spring, in particular into June, July. So looking for opportunities in both of those, potentially on the short side. Be patient, and it's nice to have a game plan, but you want to be looking for the action to come along and support your conviction. And in this case, both of these two excesses on the upside right now, but a little early to put any money to use there.
And you have a special to celebrate the long weekend in the U.S.
For the long weekend, we are still 25% off new annual subscriptions, and for anybody who wants to have just a look at the gold report and some of our others, they could do the just a 2-month trial and take a look at the research. So go to chartsandmarkets.com, and on the front page of the website, you'll see the links there for the subscriptions.
Ross, thank you so much for the update.
Good to be with you, Jim.
My guest has been Ross Clark from chartsandmarkets.com. You can find him on X at Charts by Ross. Coming up, Victor Adair next on This Week in Money.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Victor Adair, recently retired from nearly 50 years of being in the brokerage business in BC, but still very active in the markets. His website, victoradair.ca. He's speaking to us from beautiful Parksville on Vancouver Island. Welcome back to This Week in Money.
Jim, it's always a pleasure to visit with you. Thank you.
Before we discuss individual markets, there seems to have been a significant change in sentiment across markets since we last talked a month ago. The stock market has soared, interest rates have dropped, the U.S. dollar is weaker. Has there been a common denominator that's caused all this to happen?
Well, there has been, and I pay a lot of attention to correlations between markets and even within different markets. And it's not surprising that the markets would have moved this way. In other words, stocks up, bond prices rising, and the U.S. dollar falling. I think for the last 2 years, it feels like actually for almost forever, that the market's been kind of living and dying on what they think the Fed is going to do. And certainly the last couple of years, the Fed was motivated to do whatever they did, largely because of what they thought was happening with inflation, like it was their job to get it down and, to just keep it robust here. The Fed decided to raise interest rates, and relative to where they've been over the last couple of decades, they raised rates a lot, and they raised them quickly. And while that was going on, and I wrote about this many times in my blog and talked about it in different interviews, I had the idea that the markets kept anticipating that, okay, they're going to be done now. They're going to be done now. And the thought was that once the Fed's done, it's a green light special to buy stocks. Okay, so for the last couple of years in particular, the market kind of keeps waiting. It's like a dog. Are we going to go out now? We're going to go out now? Keeps waiting, for the Fed to finally be done. So I think that's kind of what happened. And, of course, by the way, every once in a while the market kind of grudgingly accept that, darn, those guys are just going to keep rates higher for longer, So I would call it some sort of a cognitive dissonance, that the market kept hoping, that they were going to get to go out and run, even though the Fed kept saying, no, it's not going to happen. And we kind of go back and forth on that. So the latest iteration of the going back and forth seemed to be, I'm going to put myself in the spot here, but I think it was September the 20th. We had an FOMC meeting. That's when the Fed gets together and decides if they're going to do anything. And the takeaway from that, as far as the markets were concerned, is darn, the Fed's just they're being tough. They just won't bend. They're going to keep these rates higher for longer. And it's like the market finally said, okay, we got it. And what happened is, the stock market, the S&P, broke then down to new 3-month lows. Bond yields went to new multi-year highs, and the U.S. dollar went higher. And that kind of carried on until the end of October. And at the end of October, we had the swing the other way. There seemed to be maybe some dovish feathers in the wind from the Fed. We had some weak economic data, and by golly, it's back on again. The green light special, here we go. And since then, let's say the Dow has rallied about 3,000 points. I remember that used to be a big number. That's about 9% these days. The NASDAQ rallied about 14%. Apple and Microsoft are up about 15%. NVIDIA up 25%. The mega cap stocks continue to lead the broad market higher. During that same period of time, interest rates fell. The long bond, I should say, the 10-year fell from about 5% when that was a 16-year high to about 4.5%, and the U.S. dollar weakened by about 3%. So, yeah, the common denominator has been this, what I call cognitive dissonance between the market and the Fed. And so right now, I think we're kind of almost back at possibly another inflection point where I think the Fed might be going, wait a second, gee whiz, this is, we acted a little dovish, there a month ago, and the stock market's just taken that and run with it. So maybe, we're in an overdone situation. It's trying to, I guess, it's something like if you're in the market, you're trying to guess what the Fed is going to do or is not going to do, and we've kind of gone back and forth between pillar and post here, and we're still doing it. So it is the most important thing in the world, it seems, for the market to try to get on side with what the Fed really is going to do, and the past month the market thinks the Fed is done.
Do you think the stock market rally will continue?
Well, isn't that the $64 question? Or here's the thing: the seasonality, and a lot of people will look at this. And of course, we've been in a bull market basically since 1982, so it's not surprising. The seasonality is the market keeps going higher, but particularly at the end of the year, sort of into the American Thanksgiving, which we've just had this week, and then on into January, over the last number of years, the market has typically gone higher, so there's that. I kind of think, and this is also going to depend on your time frame, but I mean, I have seen it's almost like people are falling all over themselves to get into the market here. What in the vernacular on the floor we would call it, they're chasing the market higher. The mega cap stocks that have been leading the rally, I see with some of the services I look at, they are owned by hedge funds in particular, like they're owned like they've never been owned before. There used to be an expression, Jim, where the people would say, with guys in the market would say, you'll never get fired for buying IBM, okay? You could get fired for buying some piece of moose pasture somewhere. What were you thinking? But you're buying IBM. That's the marquee stock. Well, these days, nobody's going to get fired for buying Microsoft, which I believe has led the mega cap stocks, or Apple, or the other ones. That's the place to be. So that could well continue, and certainly people who manage other people's money, whether that's pension funds or just individual brokers or what have you, or anything in between, are subject to being fired if they don't keep up with the competition. So, right in through here, it's tough if you're managing other people's money to be a contrarian and say, I'm going to take profits on my Apple or my Microsoft or whatever. So that's part of what could take the market higher. On the flip side, time, and again, this is maybe short term, it seems to me the markets, we've had this terrific rally, as I say, up 10, 15% in a month, maybe a bit overdone there, particularly given that I think the Fed may be a little disappointed that there's been such an easing in financial conditions, but it's the ebb and flow, and I'm inclined to be skeptical here when I see the way the flow has gone into the market in such a rush. But at the same time, I got to pick my spots if I want to stand in front of this galloping train.
Bond prices have been trending lower over the past 3 years, but have rallied slightly since mid-October. Where do they go from here?
I'm a little more inclined to think the bond market is too excited, even though, relative to stocks, it's. They used to say, the bond market is smarter than the stock market. I don't know if that's ever was true or if it's true these days. But my big thing on bonds and why I would be sort of fundamentally bearish on bonds is the bond market, I think, is looking ahead, as all markets do. And they see nothing but a tsunami of supply coming. Now, there's a lot of money in the world, but I think this thought that governments everywhere, particularly in the States, it's so important, are going to continue to run deficit spending programs, or they're going to spend more than they take in, so they're going to make up for the balance by issuing debt. And in a way, you have to ask yourself, so who's going to buy all that paper, and at what price will they buy it? So in the vernacular, there's always going to be a buyer for U.S. Treasury paper, like it's the bedrock, blah, blah, blah. But it's the question of price. And I think this run-up we've had here, this enthusiasm that the Fed's done and inflation is down and, away to the races, I think the enthusiasm in the bond market is probably, if I was going to short the stock market or the bond market, I'd probably go short the bond market first.
What are your thoughts on the currency markets?
Well, let's start at the top. The U.S. dollar, there's a U.S. dollar index, and I generally talk about that or write about that, and it's heavily weighted toward European currencies with some Japanese yen in there, about 12% yen, and then a little bit of Canadian dollar and so on. So the U.S. dollar index, and the European currencies, by the way, the main weighting, obviously, I suppose, is the euro currency. I call it the anti-dollar in my blog, just because, for instance, if you were going to be bearish of the U.S. dollar, the first steps, as it were, would be to get long the euro. Okay, so it's the anti-dollar. So in a way, the recent little pop here has caused the U.S. dollar to fall. Historically, the U.S. dollar, you've heard me say this, capital comes to America for safety and opportunity. So the U.S. dollar is seen as, a relative safe haven, or the cleanest dirty shirt in the laundry hamper, if you just say nothing's worth the money, it's the paper it's printed on. But within that, you look at some of the individual currencies. The Japanese yen, for instance, has fallen about in half from where it was in 2012 as the government in Japan tried to get their economy out of a sort of a never-ending rut that it was in. And as the yen has been weakening all these years, people could borrow yen and then switch into other currencies. We would call that a carry trade, and that would exacerbate or cause that weakening trend to continue. And there's been good reason. The Japanese central bank just keeps short-term interest rates negative. Bond yields are below 1%. It's like, why would anybody want to buy that when you can buy a U.S. Treasury for 5%? I think at some point as we go forward here, the Japanese yen is going to be a big buy. And this will be depending, and by the way, people have been saying that for some time and lost their shirts making that bet, so, be careful. But the yen just seems to be so weak, and there's the positioning negative the yen is just massive. So if something happens that starts the yen to rally, some of those people that are massively short of yen may have to unwind those positions. The Canadian dollar, we had our high for the year back in July. It's fallen off about, call it 4 cents from then, roughly from 76 down to 72. I think the currency markets, or people that are trading currencies, are looking at Canada. They can easily develop a negative view in terms of the debt servicing that we have here. In America, the typical mortgage is a 30-year term. In Canada, it's 5. And so a lot of people are going to be coming up for renewal on their mortgage right now and in the next year or two at likely, much higher rates than what they're paying. And, real estate, or the run-up in real estate prices, has been a big deal for Canada. The home building construction industry has been a big part of the Canadian economy. And we're more highly levered to debt. I'm going out on a limb to say that, but this is just like my sense of it, than Americans are. And rising interest rates. I think I've said on your show before, I know I've written about it, that people talked about if interest rates go up so much, so quickly, somewhere something's going to break. That's kind of been the term. And I've said, well, maybe it's Canada. Canada's pretty highly levered to rising interest rates, and interest rates stay high, that could hurt Canada. Now, on the back of that, the positioning in Canada right now, when I say Canada, I mean the Canadian dollar, is extremely bearish. Like speculators are heavily short the Canadian dollar. And this is just part of my nature. I see that and go, okay, if for some reason the Canada was to start to do a little better, there's a lot of people got to cover short positions. They're going to take the market higher. So you're asking me about currencies. I'm a little probably neutral on the U.S. dollar as to where it would go, but I'm inclined to think there's sort of buying opportunities in the yen and in the Canadian dollar for different reasons, but largely because there are so many people that are so short in Canada and yen.
Gold nearly made a new low for the year in early October, but rallied almost $200 on worries that the conflict in Israel could spread. What will take gold to new all-time highs?
Well, that's interesting. We can go back to the old chestnuts of, gold has high negative correlation to the U.S. dollar and to real interest rates. In other words, if the U.S. dollar is strong and real interest rates are high and rising, that's like a toxic environment for gold. The spike that we had from the lows in October was clearly related to the conflict that was developing in Israel. We had the similar spike, by the way, when the Russians invaded Ukraine back in February, March of 2022. Over the years, we've seen these spikes in gold, what we call these geopolitical spikes, and they seem to peter out. You get a quick move of, let's call it 10% or so in size, and then the market, either the conflict kind of just becomes less important in terms of the market's view of what counts or whatever, but the prices settle back. I think we've seen some settling back there in gold. We rallied $200. Maybe we set back, let's call it $70, $80, something like that. What would take the gold price higher, I think, is maybe a more fundamental support for the gold market, and that would be what I just mentioned about the bond market. Deficit spending. What deficit spending does, it creates more government debt, and it diminishes the purchasing power of the currency, which a lot of people would just say, well, that is inflation. But I think that is, as the gold market looks ahead and sees that is going to continue, I think that's a really fundamentally bullish backdrop for the gold market. So the more that continues, or let's say if that comes into focus, like people start to say, hey, there's this thing about all the deficit spending that should be good for gold, then, that could help the gold market. I think that is really the background support. We've seen, and this is public, and everybody that trades gold knows this, so it's no surprise, we've seen more central bank buying of gold in the last, call it, year or so than we've ever seen before. Now, part of that certainly was people, I should say government, central banks, that wanted, let's say, some protection from the reach of the American police. Like if you were Russia and you had your overseas assets confiscated because you had gone into Ukraine, if you'd have had those overseas assets, your assets in gold and had them, at home, the United States couldn't touch it. So I think there's been some of that. The majority of the central bank buying has been by China and by Russia, but they're buying it. You might even see that the way we would look at OPEC when OPEC says they're going to cut production. Okay. China and Russia also happen to be the largest gold producers in the world. So, and I wrote about this in my blog last week or the week before. Do you think that when the Central Bank of China buys gold from the Chinese gold mining companies, and the same in Russia, do you think the companies are getting a fair price? I wonder. I don't know, but I'm going to think they're probably getting whittled down a bit. So, yeah, the Chinese and the Russians are the world's largest gold producers. They're holding production off the market by buying it with their central banks for two purposes. Maybe, it helps support the price of gold, as if OPEC doesn't produce as much oil, that helps support the price of oil, and also gives them that protection from, or gets them beyond the reach maybe of the American financial police if things go that way. So the best big picture background support for gold, I think, is continuing deficits and deficit spending from the governments and the debasement of the currencies as a result, and that'll put a bid in gold. Now, that's big picture stuff. Shorter term, week to week, month to month, other things are going to come up, but I think that's the big support in the background.
WTI crude traded at $95 in September, its best price over a year, but it's traded on either side of $75 the last few days. Why has it fallen, and what's next for crude?
I think I don't want to be a smartass here, but I think the classic answer was at $95. Maybe we got too high too quickly. That was certainly the highest price we'd seen in over a year. There's a lot of speculative activity in the crude oil futures markets, and as the price came down, if you had been positioned long of crude and the price is going down, you might become a seller. And if you're a seller and the market's wise, people would back away from buying, so the price falls that much more. So I think there's some of that, but I think there's also a real change in the supply-demand imbalance. And one of the ways I look at that is in the futures markets, you can trade crude for delivery every month going out for about the next 5 years. And we call that the forward market. And the prices of forward contracts will change relative to the price of the front month and so on. So for the past, I'm going to go out on a limb here, year or two anyway, we've had a backwardation market where the front month or the spot prices are higher than the deferred prices. And that is typically something where demand for the product right now is strong, and it creates that kind of a forward curve. Well, when the price of crude oil fell from $95 to $75, that forward curve went flat. The 6-month curve had been about a $10 premium, and it went down to nothing, which meant to me that there was definitely a weakening in demand for crude oil. So anyway, prices fell off the way they did. We had a little bit of a pop in that decline from $95 down to $75 when the crisis started, the conflict started in Israel. Thinking, I guess, there was that, if the conflict spreads in the Middle East to the degree that Mideast source crude oil can't be transported away from the Middle East, that would be very bullish for the price of crude oil. But as time went by and it seemed as though the conflict was going to be contained, at least to the degree that the transport of crude oil out of the Middle East to the rest of the world wasn't going to be interrupted, then, prices carried on down to the $75 level. We have OPEC Plus, as we call it these days, and that means OPEC and Russia, which hasn't officially joined. They're going to have a virtual meeting this coming Thursday, I think it is, November the 30th. And there will be an opportunity then for OPEC to discuss whether or not they want to put further limits on the production of crude oil. If they do, and if the market believes that the different participants will honor those cutbacks in production, and that's not a closed case, then that will be bullish for the price of crude. So that's kind of what's next for crude. Certainly right in the immediate future is what that OPEC meeting is going to look like. On a longer-term basis, I mean, the main thing for crude prices, I think the main variable is what we use fossil fuels for transportation. And if we have more, I should say less and less fossil fuel burning transportation vehicles, then that would be negative for crude. But I'm of the side, and the folks that I pay attention to, the research that I look at, I think we're going to see higher fossil fuel prices as we go into the future, if for no other reason. This is a real big picture one. The developing world sees how we live, and they want to live that way. And the easiest transition, energy-wise, other than is to just use more fossil fuels, certainly oil and natural gas. So I think that's the underlying fundamental bullish argument for fossil fuels.
In your weekly trading desk notes at victoradair.ca, you have a section called On My Radar, where you write about trades you're thinking about. Well, what are you thinking about?
Yeah, I think right now I'm very focused on this cognitive dissonance, as I called it, between the market and the Federal Reserve. And and this is fairly short-term thinking. I'm inclined to think that, say, the stock market has run up too much too quickly, the bond market the same, and so I'd be looking for taking positions against that. Now, when I say, here's how I'd go about that. I guess a couple of the things that are really important to me is what I would call sentiment in the market, and then positioning. I mean, if you're bullish something, but you're not long that, well, okay, I mean, more likely, if you're long something, you're going to be bullish. So there's that. I'm going to be looking at how that is in the market. And I think I've seen people chase the stock market higher, for instance. I think we've seen people that were maybe sitting on the fence have decided, gee whiz, I can't, particularly, by the way, people that are managing other people's money. I've got to be in the market, and I've got to have these stocks on my sheets at the end of the year. So there's that. Then there's timing, and timing is both keeping you've heard me say this, keeping the time horizon of my trading in sync with the time horizon of my analysis. So if I said to you just moments ago, I think the long-term market picture for both gold and crude oil is bullish, but it wouldn't surprise me at all if, between now and the end of the year or whatever, prices went down. So that's what I mean by time frames of trading and analysis. Keep those in sync. When I'm going to put a trade on, probably I'm going to develop an attitude. As I just said, I think maybe the stocks have gone too far, bonds probably gone too far. So that's my attitude. Then I'm looking, in terms of pulling the trigger, I'm looking for some market action that's going to make me say, okay, now's the time to get in. I don't want to say, I'm bearish stock market and it's just going straight up, so this is a good time to get short. No, I got to wait until I see some confirmation that the idea I had is maybe starting to develop. And maybe I don't see it, so I don't make the trade. And also that market action is going to help me manage the risks on a trade. So let me give you an example here. The Canadian dollar has been trending lower for the past 4 or 5 months since it's made its high back in July. I know, because of the data that we can look at, that a lot of speculators are short of the Canadian dollar, with good reason. And I was talking about in Canada, the heavy leverage in debt and so on, and so speculators see that. Now, if something happens, and something did happen in the market where we got some bad news, the market broke down and then came right back again, to me that was a signal or a market action signal that maybe we're getting a turn in the market. I'll give you an even better example. In the gold market, I bought the gold market on the Friday before the Saturday when the Hamas attacks happened. Clearly, I didn't have any idea that was going to happen, but I had seen the gold market trade to new lows, just about made new lows for the year, and I think it was an unemployment number that day that kind of just give it one more shove. But then it turned around going toward the end of the day and was closing toward the high of the day. I thought this market at that time was extremely oversold, and I just took that as a sign, okay, I can buy that market. Okay, that's the market action for confirmation of my thought that the market's overdone. And it also gave me a risk management point. If the market, instead of going higher, trades below the Friday lows when I bought it, I'm wrong, and I'm out of the trade. So that's kind of how I do it. I develop these attitudes. So right now, I'm long in the Canadian dollar for those kind of reasons, and I'd be looking for opportunities to take a position on the short side in stocks and in bonds.
Victor, thank you so much for being on This Week in Money.
Jim, it's always a pleasure to talk to you. Actually, it's fun. I really enjoy it. Thank you for having me on.
My guest has been Victor Adair, recently retired from nearly 50 years in the brokerage business. Check out his website, victoradair.ca. Coming up, Hilliard MacBeth, next on This Week in Money.
Recyclico, making lithium-ion last forever. Recyclico's patented recycling process achieves up to 100% recovery of battery metals from lithium-ion batteries for electric vehicles, including cobalt, lithium, nickel, manganese, and aluminum. Recyclico Battery Materials Incorporated trades on the TSX Venture AMY, on the OTCQB AMYZF, and Frankfurt ID4. For more information, visit recyclico.com or phone us at 778-574-4444. Recyclico, making lithium-ion last forever.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Hilliard MacBeth, author of the second edition of the book, When the Bubble Burst, Surviving the Canadian Real Estate Crash. She's also a portfolio manager and financial advisor in Edmonton. Welcome back to This Week in Money.
It's great to be back on the show.
Hilliard, how's the book doing and where can people get it?
Well, it's still in publication, which is pretty interesting because it's been between the first edition and the second edition. Now it's up to about 8 years, but and they can get it at all the best bookstores everywhere. That's what we always say, and also online with all the different online services as well. And there's two editions: first edition, second edition. So make sure you get the second edition, which is the red, has red writing on the cover.
Do you believe stock markets can move higher into next year, 2025, and even 2026?
There's been quite a rally the last year. Basically, the rally has lasted for most of a year. So what happened? You got to go back to the beginning of the year before, when the market peaked and it went into a bear market. It went down about 20% in 9 months to about October of 2022. And then it's had this rally that went till the summer of 2023. Then we had a sell-off, and now we're having another rally. So it's still lower than it was in December of 2021, January 2022, when the bear market started. So the question is, are we still in a bear market, or have we started a new bull market? And there's different opinions, but my opinion is that we're still in a bear market. We haven't surpassed the numbers from almost 2 years ago now. And there's a bunch of headwinds facing us. So the short answer to the question is probably the market has to sell off further before it can reach new heights in 2024, 2025. And the biggest headwinds are there's a fairly high probability of a recession. In fact, Canada may already be in a recession. Germany for sure is in a recession. China's really struggling. There's several countries around the world are either in a recession or right on the brink of recession. The U.S. is the only one that is showing some strength, but that can change fairly quickly. And the main problem is, of course, everybody knows that interest rates have gone from basically zero up to about 5%. The prime rate in Canada is at 7.2%. Mortgage rates in the U.S., the 30-year mortgage rates are at 8%. So we don't know yet how much impact those numbers are going to have, but the suspicion is that it's going to have a big impact. It just hasn't hit yet.
Could gold-backed currencies be viable at $2,000 gold, and is gold likely to head higher from here?
Gold does well. It's interesting. I do a weekend note that comes out on Friday, and this week on Friday it will be on gold. So, gold actually does well. Going back to 1971, I found some data that show that gold does well when the market is selling off, and when we're in a recession. It's kind of like a hedge against Armageddon, if you like. And so if the stock market sells off, as I was saying just a minute ago, and if we go into recession in the U.S., then gold will probably do well. It's interesting. It's just poked its head above $2,000. It's still not back to the high that was reached in 1980, which was now it's much higher in nominal terms. It was $850 then was the peak, but adjusted for inflation, gold still has to go a little bit higher, not a whole lot higher. I think it's somewhere around $2,500, $2,600 in today's dollar to reach a new high. But gold is interesting because it's considered a hedge, but it's also the negative on gold is that it doesn't pay any interest or any dividends. So you kind of have to be wanting to hold gold for protection against your other assets rather than something that's going to give you any income. And it's been out of favor too recently, I think, because the people that normally would be gold bugs, as they're called, I think they went into cryptocurrencies and things like that. So those same people would have been buying gold 40 years ago, and now they're buying other more exotic things.
We're hearing the real inflation rate in Canada could be as high as 38%. What are you hearing?
Well, so the problem is that this is interesting because everybody talks about inflation, and they quote something called the CPI, which stands for Consumer Price Index. Well, the Consumer Price Index doesn't actually measure inflation. It's an index that was constructed in the early 80s, so 40 years ago, because inflation had been very, very strong in the late 70s, early 80s, and a lot of the labor agreements had introduced a clause called the cost of living adjustment, and they needed an index to so that the agreements could benchmark themselves against an index. So they wanted to do an index that didn't show inflation to be too high, because all these people, governments and companies, would have to pay a higher salary after doing the cost of living adjustment. So the CPI was constructed not to show inflation, but to show something that would be acceptable for those labor contracts. It's really hard to know how to adjust it. I actually talked about it at length in my second edition of my book. For instance, house prices are not in there. So if house prices had been in there in Toronto, from 2020 to 2022, housing being the biggest weight in the CPI index, then inflation would have gone through the roof, because maybe would have even reached 30%. But that's not the way they calculate it. They calculate it using a monthly payments system, which is basically means the house price doesn't enter into it at all. So food, energy, housing, those are the three big ones. And if you calculate it differently, you probably could get it to 38%. But you have to decide when you construct those CPI indexes how to measure these things, and they made the decision to measure it in a different way. On the other hand, though, if TD just put out a forecast saying house prices are going to drop by 10%, and that's probably way too moderate. It's probably going to drop a lot more than that in the next 12 months. And if you had house prices in the index, then inflation would go negative, and it would go negative by quite a big amount, because the weighting on shelter, as they call it, is over 30% on the headline CPI, and it's over 40% on the core CPI. So depending on how you calculate it, inflation could be quite a bit higher than it's been reported as, and it could also go quite a bit lower if the housing bubble bursts.
Considering mortgage rates are up significantly, home prices are still buoyant. What do you see ahead for Canadian real estate as you mentioned the 10% thing? Because TD Economics is predicting a 10% drop.
Yeah, TD Economics is predicting 10%. Now, their earnings are coming up at the end of this month, so in just less than 10 days, and along with Royal Bank and Scotia and Commerce and all the others. And one of the biggest things that determine the profits in the banks, of course, is lending to households, and the biggest part of that is mortgages. And it's been phenomenal. For the last 40 years, the banks have done nothing but make huge profits off of all that because they've had no losses. They have basically the myth that has developed over the years, even through the 2009 global financial crisis, is that Canadians never default on their mortgage. So you can count on them to keep paying their mortgage no matter what. And that makes a difference to bank earnings because they have to estimate how many loan losses they're going to have and how severe they're going to be before they calculate their net profit. So right now, they're assuming in their calculations, which is, based on the system they use is accurate, which is there's been no loan losses, so we don't have to make any reserves for loan losses related to mortgages. Well, mortgages are their biggest asset, the biggest loans that they do. So depending on what happens with house prices, depending on people start defaulting on their house prices, on their house mortgages, the bank profits will drop dramatically. Now, the bank is required by the accounting standards to forecast what their losses are going to be, and the biggest input into them, and then they have a computer model that calculates that. And the computer model works with the recent history over the last 10 or 15 years. Well, it would take a bigger than 10% drop in house prices for the TD Bank to experience any significant losses on mortgages. And so I suspect that's how they got to that number. It's called reverse engineering. So if we put the number at 30%, which is probably more realistic, 30% basically, the average house price in Canada right now is $765,000 from the TD report. 30% of that would be 200 and something, so 565,000, 540,000, somewhere in there. Well, that only takes you back to about 5 or 6 years or 10 years at the most. It's not a huge collapse. It's not a crisis, but it would be a crisis for the lending, the financial services industry that's engaged in lending to not just mortgages, but credit cards, car loans, all that kind of stuff. Because when these mortgages renew at 7-8%, or in Canada 6.5%, that means $1,000, $2,000, $3,000, $4,000 more in monthly payments going to handle the mortgage, and that means they're going to have to cut something else out, and that means a recession. So, as I mentioned a minute ago, we haven't seen the full impact of this, but one way you could watch for it, I don't expect that they'll take full provisions for the possibility of losses on their mortgage loans this time around. But at some point, if house prices go down more, they will have to start making those provisions, and that'll hurt bank earnings. So that'll be difficult for the Canadian stock market because the banks are a really big percentage of the index in Canada. In the U.S., it's a much smaller percentage, and they have a different system down there. So that's the thing to watch for: is will these higher interest rates cause people to start defaulting on their mortgages, which will cause house prices to drop much more than 10%.
Is mortgage credit being constricted?
Well, so that's a great question because maybe what's behind that question is the fact that the growth in mortgages. So the banks report every month to the regulator what their loans outstanding are, and the rate of growth, I think it's still a positive number, but it's a very tiny positive number, and it's the slowest rate in probably the last 40 years. So, because usually when people are buying houses, there's more people taking out new mortgages and refinancing existing mortgages than there are people paying down mortgages. And at the moment, it's almost to the point where people are paying back their mortgages faster than they're taking out new mortgages. Other people are taking out new mortgages, and when that happens, it's the whole money supply because the mortgage loans are the biggest part of the money supply, the whole, at least of the private sector money supply, the whole thing starts to shrink, and that'll have a huge impact on a lot of different entities. Because when you pay down a loan on your mortgage or on your car or on your HELOC, that money kind of just gets taken out of circulation or disappears. It's not injecting any new buying power into the economy, and the economy needs new buying power all the time. So I don't think it's being restricted. I think basically what's happened is, well, in a way, the banks have become much more careful. They're worried about the possibility of people not being able to make their mortgage payments at these rates. There's also a stress test, which banks are required to apply when you apply for the mortgage, and that's, they're stress testing at 8% now. So there'll be lots of people that won't qualify, or they'll qualify, but they'll qualify for a loan of $300,000 when the cheapest house they can find is $500,000, which means they can't buy a house. And then of course there's people themselves are watching house prices drop, and they're thinking, oh gee, maybe I should wait. And the most recent data from Toronto show a huge jump in supply and listings on the market, and no rebound really in sales. So the sales to listing ratio is very low, which means prices generally will come down.
Are some homeowners drowning in debt and living on credit cards?
Yeah, there's lots of people, and it's interesting. One of the things that you'll notice when you read these reports is, especially the banks are especially noted for doing this. They'll say, oh, well, only 51% of Canadians even have a mortgage. The rest of them are renters, or they own a house, but they paid off the mortgage, right? So there's nothing to worry about, because mortgage loans are $2 trillion, but the value of all houses out there is $4 trillion. So let's say we don't really have a debt problem. But you can't take the averages, because the averages hide all kinds of stories, and the stories are coming out now that there's a significant number of people, out of the let's say 10 million households that have a mortgage. Or it wouldn't even be that high. 10 million households in Canada, maybe 7 million have a mortgage, something like that. Out of those 7 million, maybe 10% of them or 15% of them are starting to be stressed, and if they can't do it, then they will default. And the banks are now getting to the point where they may not. Up until now, you go back to 2020, 2021, 2022. People were being told, "Oh, we'll take care of you. We'll work with you. Tell us your problems, and we'll find a way to get through this." Well, now the tone is changing a little bit. It's getting a little harsher now, and people are saying, "Well, if you don't qualify, you don't qualify, and there's nothing we can do." So, anecdotally, now this is very anecdotally, but I was talking to a doctor recently who sees 45 people a day, he claims, and a family physician, and he said several of them have told them that they have to sell their house because they can't make the payments anymore, and that's very, very unusual, as everybody knows. That it's been a long time since a significant number of people have been forced to sell their houses. And, I'm sure there's been people who couldn't make their payments, but they were always able to sell their house for more than the mortgage was worth. So then they actually didn't really have a major problem. They just sell a house and pay off their debts and move on. But if the house is worth less than their debts, as we saw in 2009 in the U.S., a significant number of people were upside down on their mortgage, then it's a different story. They end up in the U.S. They're able to walk away from their deficit on their debts versus their value of their house. But in Canada, with a couple of small exceptions, everybody's on the hook. Even if the house is sold for a loss, the lender can come after that former homeowner for the difference and force them to pay it, unless they declare personal bankruptcy. That's the only way to get out of it.
In the Trudeau government's fall economic statement, there was a significant focus on real estate. Do you think the government's plans will affect the real estate market much?
No, I don't think it's a big deal. It certainly was for optics primarily, I think, and a lot of I was reading through looking for something new, And basically, most of the provisions that they talked about were things that had already been done by the regulator, or by other people. So it was kind of a rehash of the. It's a really difficult situation for the government. Not to defend them, but certainly since 2015, when this current government came in, it's gotten a lot worse. But it was getting a lot worse going back to 2005, 2006. To me, the benchmark moment was when was the Harper government allowed zero down payment and 40-year amortization, which basically meant anybody could buy a house. Pretty much, you didn't, as long as you had a job, even if it was just part-time at Starbucks, you could probably qualify for a mortgage, or for a house. But and then they didn't. That didn't last very long. Then they changed it to 35 years, and then all that. But they got a lot of people into the housing market at that time, and it worked out because house prices went up. People got through the global financial crisis in 2009, and the house prices kept going up. So that many governments. You could even go back earlier to Paul Martin's government in the 1990s, and that he started the Canadian mortgage bond thing, which allowed lenders to be more aggressive in their lending. So every government along the way, liberal and conservative, has contributed to this. And so a few new wrinkles, as was revealed this week in the mini budget, not going to change that. I mean, that's been going on now for 20 plus years, and the big thing to watch is that Canadians are among the most indebted household people in the world when you take the individual family side of it, and that has to be dealt with. And of course, on the other side of it, the corporate side, Canadian corporations are some of the most indebted corporations in the world as well. So in total, the private sector made up of those two is extremely levered, as they say, and we don't know how we get out of that, but it certainly will require some major adjustments, much bigger things than what was announced this week by the government.
In the 2023 Fall Economic Statement released this week, there's a section titled Building Canada's Strong Electric Vehicle Battery Supply Chain. Your thoughts on that?
Yeah, well, we're way behind. I mean, so it's a long story. To keep it really short, most of the battery manufacturing takes place either in Tesla or in Chinese factories. The U.S. has this new thing called the IRA, Inflation Reduction Act, but it includes inside it a tremendous amount of tax breaks and incentives for people to start manufacturing electric vehicles and batteries in the U.S., and that's triggered a huge amount of activity. So this little bit that we're getting in Canada is related to sort of a competition with that. But the problem is that it requires that Quebec and mostly I think it's just been Quebec and Ontario so far, need to offer up some pretty big incentives for people to establish their battery factory in Canada versus going to the U.S. or even to Europe for that matter. So it's a very tough situation. Canada's getting left behind. What we need is our own car. We need an electric car. And what was that car that was canceled? You'll remember the name of it. If we could have a Canadian version of an electric car with a Canadian-made battery, it would be a fantastic thing. But short of that, we're just getting the crumbs off the table. The big boys are eating at the table, and we're just playing around for the scraps that fell off the table. We need to get much more into the game.
Also in the Fall Economic Update, deficits for as far as the eye can see. What could this mean for inflation and interest rates?
So going back to what we said about the mortgage growth has gone down to close to zero. The problem with that is, of course, if you don't have a positive number in that amount of credit that's being available in the economy, that we're talking about as a recession or even a depression. That's basically what happened in the 1920s and 1930s. The private sector borrowing went through the roof in the 1920s. People got extremely deep into debt. And then in the 1930s, the early 1930s, they stopped going into debt and they started to try and get out of debt, and they defaulted and all that stuff. So if the government doesn't pick up the slack by expanding its going into debt, or some people would call it printing of money, then everybody's going to suffer, because without that credit in the economy, there's a whole bunch of incomes that will shrink. Almost all income is related to somebody in the private sector borrowing money to make something happen, or some government spending more money than it takes in taxation. So you wouldn't want the government to be pulling back on that accelerator in the form of spending more than what they're taking in, at the same time that the private sector is pulling back. The private sector doesn't have an option. If they don't qualify for the loan, then they can't spend the money. The government has a choice. They can decide to go deeper into debt, but politically it might be difficult, because at the next election, given the polls, it looks like there's going to be a change to a more conservative government. And the first thing they'll probably do is say, well, these deficits are much too big. We need to rein them in. And of course, that'll be a negative hit to the amount of buying power that's in the economy. At the same time that other people are in the private sector, trying to pay down their debts. It's a nightmare. It's so important that that Keynes, who was writing in the 1930s about, and of course the worldwide depression was top of mind when he was writing his book, in 1936 book. He called it The Paradox of Thrift, and what he said was, you cannot pay down your debts all at the same time, because everybody's borrowing is somebody else's income, and everybody's debt repayment is somebody else's loss of income. So when everybody tries to pay down their debts at the same time, it doesn't work, because it creates a depression in the case of the 1930s. And then people's incomes drop so fast that they're never able to have enough money to pay down their debts. So it's a major problem. I think the deficits are too large. I think the government in 2020, when COVID hit, went way too far in terms of putting money into the economy. That's probably what caused the inflation, although I guess every government did it, because inflation went up worldwide. It wasn't just Canada. But now they've got the problem is they've expanded their debts substantially, and the deficit seems to carry on now. And if they try and pull back on it, it's going to be very difficult and very harmful to the private sector, because that a lot of the government spending that comes from those deficits, it's a check that gets written to somebody, either a Canadian household or a Canadian corporation that has a contract with the government. So if you cut back on those, you're going to put a lot of people out of work.
The fall economic statement included unemployment projections. Should any unemployment numbers from the government be believed?
Well, I saw that. I couldn't believe it. So I think, I'm just going by memory, I don't have it in front of me, but I think it was 5.7% unemployment, which was the number that it's currently at. And it's just higher in the U.S., by the way. The U.S. is down around 4 or something, just under 4%. And they had it going up to 6.5. Well, the only way that could be correct is if we get what's called a soft landing, which is, soft landings are so rare that they're sort of classified in the same class as unicorns or something like that. So a minor uptick. When the unemployment rate goes up, it goes up a lot more than a fraction of 1%. And because usually when the unemployment rate goes up, it's because we're in a recession, and all kinds of stuff happens at the same time. So that's a very odd projection. When I saw it, I thought, oh, they're just trying to get through to the next election. That's basically. But there's no way, if we have a recession in 2024, which it looks like we will, that the unemployment rate won't go. It'll be higher than 6.5.
The Trudeau government's full economic statement had this line on page 121. We're still trying to figure out what it means. Fighting climate change also fights environmental racism. Any thoughts on what that means?
Well, I'm not quite sure what they mean by that, but there is a huge aspect of this climate change, global warming, transition away from fossil fuels, is the fairness of it. So, and there's a meeting coming up in imminently. It's just about to start. It's being headquartered in the Middle East somewhere, in one of those oil-producing countries. And there's always a big contingent that goes to those things that says, it's not fair because you guys in the wealthy countries, like the U.S. especially, have created almost all of the global warming emissions, the CO2 emissions, up till now. And then we're going to have to pay the price for it when you cut back on these emissions. So you need to give us some money to help us get through the transition, right? So of course the U.S. and the other developed countries are very reluctant to do this, but there is some truth to what they say. And they, for just to give you one example, the total daily usage of crude oil is about 100 million barrels. I'm rounding off to an even number. And the U.S. uses 20 million of those 100. So that's 20% for the U.S. Canada's similar, by the way, in a percentage terms, with only the U.S. has less than 5% of the population. So they're 4 times more crude oil intensive than the average. And that's, some of these countries that are quite poor are using very little crude oil in relation to their size. So they have a decent argument. Now, of that 20 million barrels that the U.S. uses, a full 9 million barrels of it goes into cars and light trucks. So if you convert those to electric, then that'll reduce the U.S. emissions very quickly. Doesn't solve the whole problem, but it makes a huge step forward. But there will be a big fight, and there's an element of racism, and I guess but it's more in my mind it's not just racism; it's rich and poor, and there's a very big fight going on. And so far, the rich countries have made all kinds of noises about helping the poor countries make the transition, but very little cash has actually been transferred from the rich country to the poor country.
Isn't Australia promising to help out? I think it's Tonga, one of the small Pacific Island nations, to evacuate in case ocean levels go higher.
Yeah,
I mean, concrete action there.
Yeah, in the case of those, some of those countries that are going to disappear altogether if the sea level rises, it seems like it's inevitable that the sea level is going to rise enough to drown some of those people. They will have to help, but unfortunately, with all the real estate that's being built in Miami, Florida, it's like a whole bunch of money is going to go to put up sandbags around the foundations of some of these high-rise towers. I can't believe it, what they're doing. I don't know. Some of your listeners will have been to Florida and looked. If you spend any time there, it feels to me like we weren't right in Miami. We were just a little bit north of Miami, but it feels to me like the water table is about 1 or 2 centimeters below your feet wherever you go. So any kind of a rise in the sea levels is going to really be difficult for a place like Miami. And yet you read every day about people that are moving there. Big Wall Street firms are relocating their whole being to Miami Beach. So it doesn't take melting of the ice cap in Antarctica and Greenland, although that is happening. It doesn't take that. It just basically all it takes is a warming of the water in the ocean for it to expand, and then the volume increases and the level rises, and then it floods ashore. And it'll affect rich people too. I mean, England, the Thames River, London, England, the water will come up there if the sea level rises 2 or 3 meters, and it'll cause all kinds of problems. Manhattan's another one where rich people live. Be the same thing there. So
We'll have it here in Vancouver and Victoria.
Yeah, well, there's rich people in Vancouver too, I think. Or at least, they don't report any income on their income tax, but they have very valuable houses.
Yeah, no income, but a $13 million compound.
A 22-year-old, yeah, exactly.
A student who doesn't know what their dad does for a living.
Exactly.
Does Canada still have a AAA credit rating?
I think it does, and there's very few countries now that do of the size. I remember. Now this might have changed. It's been a while since I looked at it, but last time I looked at it, probably a year or two ago, Germany and Canada were the only two countries above a certain size that had a AAA credit rating, and the U.S. lost theirs. Now, it depends on how you measure it, right? Because there's a couple of the ratings agencies, there's several of them, dropped the U.S. from AAA to AA plus, and then in this latest skirmish over the increase in the budget deadline, or there's threats that they may. A couple of the other rating agencies have hinted that they might drop the U.S., but so far Canada's stayed in there. What kept Canada in the AAA was, up until recently, the federal government had borrowed relatively small amounts of money compared to other like the federal government likes to brag it's at 40% of GDP, and the U.S. was at 100% of GDP. So on the surface, it looked like Canada was really prudent in their government borrowing, but what they forgot to include, or what they chose to exclude, was the borrowings of provinces like Ontario. And when you add all that in, then Canada and the U.S. are actually quite similar, because in the U.S. states are not allowed to borrow like they are in Canada. So you've got a bit of a misperception there. Canada's got a reputation as being a very prudent, good living, careful country, and they also have a AAA credit rating, so it's viewed as a bit of a safe haven. But I don't know if it's going to last much longer, because we, in our enthusiasm for real estate, we've borrowed a lot of money, and if the real estate prices go down, then some of those debts will never be repaid.
Well, at least in BC, they have a law that says municipalities cannot run a deficit. Yeah, which I think is a pretty wise law.
And that's the case with the states, and even California. I mean, they get into debt, but they're not allowed to run a deficit for operating expenses the way Ontario and BC and all these other, BC is actually pretty good. Ontario and Quebec and some of these other provinces have. The way they get around in the U.S. is the law says the state is not allowed to run a deficit, so they have these project loans, and then they have a referendum, and it'll say, you want to spend $1 billion on this new bridge or whatever, and people will vote on whether they want to do it. That's not counted as part of the deficit, so that's the way they get around it down there. But it is true, the states in the U.S. are much less indebted than provinces like Ontario, and even Alberta's got some debt. So here we are. We got to figure out what to do about it. I mean, in China, the government has got some debt, but in China they allow these local municipal. Some of these local municipal authorities are huge compared to Canadian provinces, and they borrow immense amounts of money from Chinese banks. And up until recently, they were using it to do real estate projects of huge apartment buildings. And now they're going through a really big crisis there based on that. But those local governments were getting a lot of revenue from real estate, and they were borrowing a lot of money to help developers build real estate. And so it's different in different countries, but a lot of times the debt does work its way back to real estate. And we haven't even talked about commercial real estate.
What's happening in China's economy and real estate market, and could repercussions of it reach Canada, especially in real estate and the housing market?
So in China, it's absolutely staggering, the size. I mean, we talked in the past about a couple of these big real estate developers. China Evergrande was the one we talked about starting more than 2 years ago. They've gone bankrupt, but the biggest developer, Country Garden, was considered to be safe. Well, starting at about 6 months ago, Country Garden started to get into trouble. So China Evergrande was second largest, and Country Garden was the largest. And Country Garden's the largest by quite a lot. It's got 4 times as many projects as China Evergrande. And the banks were willing to lend to them. These local municipal authorities I just mentioned were involved, and everybody was cruising along. Chinese families would gather up all their money and buy an apartment, and they didn't actually move into the apartment. It was considered like a place to store investment money there, and you leave it pristine and leave it empty. Don't move into it. So they were able to build these things really at at an amazing pace, and it kept the economy going. It was a lot of employment, a lot of revenue for the local authorities, a lot of business for the Chinese banks. If you look at a list of the top 10 biggest banks in the world, 5 or 6 of them are in China, and this is a big part of their business is real estate. So now what's happened is these big developers like Country Garden are unable to pay their debts, and they're unable to pay their suppliers as well. So just this week, and for a long time, sort of going back 2 years, more than 2 years, when China Evergrande got into trouble, people were expecting the government of China to do a bailout because it's such an important sector in there. It's even more important than real estate is in Canada. And but the government did a little bit, but very, very small moves. And so this week, it looks like they're making bigger moves in terms of they want these companies like Country Garden to finish the projects. There's a whole bunch of partly built projects, and politically it's very bad for the government because these people put their life savings in some cases into these things. So so they want them to finish it, and they're going to provide some loans to the developers to finish the project. But there was a total of, in the case of China Evergrande, I don't know the total of all of the things, but just in the case of that one company, there was $30 billion that they owed to foreign investors that had lent money, and there's certainly no indication that any of those people are going to see their money paid back. I suspect the total of all of the real estate companies that are doing this is probably over $100 billion US, and I don't think they're the lenders, the international lenders, most of them from the US and Europe, are going to see their money back. They're not going to get paid because the priority is, first of all, to finish the project, pay the, in order to finish the project, you got to pay the people that supply the labor and the concrete and the wood and everything, and then pay back the local lenders. And then if there's any money left over at the end, you could pay back the foreign lenders. Well, there won't be any money left over, so it's very unlikely. So would it impact Canada? Well, for sure. Everybody, for as long as I've been involved in this, and it's more than 8 years now, in Canada, we kept hearing, these people come, from China or other countries, and they pay in cash and they must have a lot of money to invest in, and they don't buy cheap houses, they buy expensive houses in Vancouver and West Van with cash. They say, how can they possibly, pay in cash? Well, they probably have borrowed the money against their property in China. So they own some property in China. The Chinese property's gone up in value. Now they've got some money that they can. Then there was another thing that was happening. They were pooling the resources of several families in a village, getting a bundle of money put together, and they would come in. There was no one owner. There was a bunch of owners pooled together, and they would bring the cash over, and they wouldn't take out a mortgage in Canada. They would, if they had any debt, that would be in China. So to the extent that the property prices are falling in China, as they are, and there's trouble in the property market in China, that source of money coming into the Vancouver and Toronto markets, even Calgary sees a lot of that money too, will dry up, and I suspect it already has dried up, and so that'll affect the Canadian market. But the bigger effect on the Canadian market, that's a part, people debate. CMHC says it's 3%. Other people say it's as high as 20% or 30%. It's probably close to the higher number than the lower number, but still, even at 20% of foreign buying coming in, that still leaves 80% domestic. And the domestic buying is there's some speculators in there, sure, but a lot of it's just families, right? And Canadian families. And if they can't qualify at with mortgage rates at 6.5% and the stress test at 8.5%, then they can't buy at these prices, and the prices will have to come down. So it'll be a combination of higher interest rates, probably a recession, money from China and other countries drying up because they've got more problems at home now, and altogether it'll mean a real cooling off of the property market in Canada.
Is artificial intelligence just next-level computer programming?
Well, so there's one of the early founders of artificial intelligence is a guy named Jeffrey Hinton in Toronto, and he talked about it. And originally they thought that they would just do basically, that if you give you an idea, you remember the IBM computer that was going to beat the chess masters, and it goes back decades now. I think eventually the computer started winning, and now they don't have that competition anymore. But there's a couple of ways to do it. There's like you could just feed into the computer all the moves made by all of the grandmasters and all the matches, and hope that the computer kind of starts copying them. Or what happened in the case of, I think this is what happened, was they basically the computer was quite stupid about it, really, and they just basically looked at the board, and with very rapid computing capacity, they could just calculate all the possible outcomes of every move that they could make, and no human could do that, obviously, and then make the best move, and then that's sort of like just brute force, right? But would you call that intelligence? I wouldn't call that intelligence. That's just like very rapid computing power. So that's one thing. And then at the other end of the scale is what Geoffrey Hinton. So Geoffrey Hinton recently turned negative on artificial intelligence in the OpenAI project, which he had been involved in, and Google's got one, and they've all got projects. And this big flap at OpenAI, the guy who fired Sam Altman, his first name is Ilya, worked with Geoffrey Hinton in Toronto at the U of T before he went and joined OpenAI. So it's a very small community. The next level, though, is a different kind of intelligence where you get a bunch of computers and you link them all together, as Geoffrey Hinton pointed out, and they can learn from each other. Now, that's another whole different level of compared to the IBM computer trying to beat the chess master. Now we're talking about something quite a bit more sophisticated. And the thing that Geoffrey Hinton was worried about, and the reason he turned negative on this is fairly recent, like in the last year or so, is the military applications of artificial intelligence. So the thing that really worried him was that somebody would get a hold of this incredible power and start using it for negative purposes, like killing people. And the one way I saw it described, which was kind of interesting, is imagine that you take the 1,000 smartest people in the world and you link them all together, and every thought they have and every idea they have in that can be shared with all of the other people, all of the people in that group instantaneously. And imagine how much further ahead they would move away from the rest of us who wouldn't be involved in that. And that's the worry but is it true intelligence? I don't know. It wouldn't have to be true intelligence. I mean, in the case of you take 1,000 computers, feed them a bunch of knowledge and have them interacting with each other and able to share all of their data together, it wouldn't necessarily be what would maybe the true definition of intelligence, but it would be very powerful, and that's the worry. And Elon Musk, we talk about Elon Musk and Tesla quite a bit on these calls. He was one of the original founders of OpenAI, and he had broke with them, and he's not happy with the direction it took. So, and I haven't seen a full explanation of what exactly the rift is over, but it's something to do with safety and worry about using this immense power for bad purposes.
People online are saying SpaceX's Starship hit the firmament when it blew up. What are you hearing?
Yeah. Well, so this Starship is amazing. It's got 33 engines. I encourage people to look at the picture. I mean, probably most people have seen it. All 33 of them burning at the same time. I mean, I can't even describe how much power is involved in that. And it went up, and then that section, once you get to a certain velocity, you don't need all that power anymore. It drops off, and in the case of SpaceX, their plan is to have it return to Earth and land and be reusable. And then the next section carries on. It needs much less power because it's already escaped most of the atmosphere of the Earth, and they've got a lot of velocity going, and they can get into orbit. It takes a tremendous amount of power to get into orbit. And but shortly after that first stage dropped off, and now the smaller vessel was going, the thing they lost contact with it, and it has an automatic self-destruction if its guidance systems are impaired. As I understand it, I don't fully understand it, but what I gathered was that there was a self-destruct button that was triggered. Either it was triggered from the ground or the ship triggered it by itself, but in any case, it blew up. So, and Elon Musk, of course, declared it a great success. So I don't know if it hit the firmament or not, but Elon Musk said it was a great success. So, but he seems to be willing to break a few eggs to make the omelet, right? So we don't know.
Well, you take a look at the initial NASA rockets that sent humans into space. The Redstone rocket, which was used for the Mercury launches, everyone blew up until the very last one that put the first American astronaut into space.
Yeah, well, they were under this immense pressure because the Soviet Union was ahead of them.
Already put a person up, yes.
Yeah, so that was. I mean, we still wouldn't have put a man on the moon if it hadn't been for the Soviet Union, right? I mean, there's no way they were going to let the Soviet Union get that far ahead of them. So even if a few people had to die or whatever, they were going to do it. So this time, they still, and the U.S. still hasn't been, up until recently, up until Elon Musk SpaceX. Most people don't know this, but the International Space Station was relying on Soviet launches to get to refuel and to resupply and all that sort of stuff. So this is interesting. The government of the U.S. backed out of this and didn't want to spend the money until a private sector company came along, SpaceX, to start doing it. Now they're relying on SpaceX to do both the space station and to put people in orbit, and they want to do so the SpaceX mission with the Starship. So this Starship is significant because it's the one that's going to take people to Mars, and this is the vision: go to Mars and establish a colony on Mars. So, but before they get there, they got to get the Starship thing working. So, and they're also going to put they're going to do a moon mission as well. And China, interestingly enough, is competing now. So it'll become not the Soviet Union, but China that's getting ahead of the U.S., and they'll have to keep up or surpass China. So it's going to be very interesting. And I don't know, the numbers are just absolutely phenomenal. They have to do 1,000 Starship launches just to get the material up into orbit before they can start sending their ship. And I think it's going to take something like 9 months to reach Mars or something. The first people that go will not be able to return. They'll die on Mars. And there's volunteers, apparently, lots of volunteers to do this. And then eventually a colony will be established. Then eventually they'll be able to set up a system on Mars where people can go and then come back.
Yeah, and the people who come back might be kind of like jellyfish because you lose 1% of your bone mass in space for every month you're up there. So if it's a 3-year mission, there's not going to be a lot of bone mass left.
And I forget what the gravity is on Mars, but I don't think
it's less.
It's less. So you're losing bone mass the whole time you're on Mars as well. So So even if the spaceship can come back, you might not be able to come back because if you came back, you'd be crushed by the atmosphere on the Earth. So,
well, you might have to live in a swimming pool for a while you regain some muscle and bone mass. And also the radiation you're exposed to for that 1.5 to 3 year mission.
Well, imagine getting a landing permit. They'll say, well, no, you're bringing back some kind of virus from Mars, and we don't want you on the Earth. So,
the original moon astronauts were put into isolation just in case of that. Yeah.
Exactly. So you got to worry about these things. You can't have these people coming back.
Ooh, Mars germs. We're hearing the net worth of the top 1% in Canada is just over $6 million each. How much of that wealth is wrapped up in real estate?
Well, it's a lot in Canada. It's a lot more in Canada than it is in the U.S. In the U.S., and I don't know the exact numbers for either country, but it sounds about right. For Canada, the U.S. would be higher because incomes are higher in the U.S. Wealth is greater than the U.S. But in the U.S., it would be more likely that a significant portion of their wealth was in shares of Google and NVIDIA and Microsoft and Apple, especially Apple, and companies like that on the stock market. In Canada, it's not likely that would happen because the big stocks like the banks and Bell Canada and TELUS and Enbridge are the ones that people like to buy, have not gone up like a factor of 100 times like they have in the U.S. Because we've got a couple of companies in that category, but very few. So we had Nortel years to go, and that went way up, but it crashed. So it's likely to be a lot of it's likely to be real estate. Now they do in those calculations. I think they include the present value of pension plan assets as well, which I honestly don't think they should include that. But so that distorts it a little bit. If you took that away, the number might drop down to 4 million or something like that, and then it would be most likely at least half of real estate. The real estate bet that Canadians have made is huge, and of course the debt associated with it is also huge. And if real estate turns out to be not such a great deal, then it'll have a big impact for a couple of decades at least on Canadians. Because you remember the thing about real estate is it's really the land that goes up in value. I mean, everybody that's looked at a 50-year-old house in Edmonton or Calgary or Vancouver or anything, that the building is worth zero. But actually it's worth a negative number because you got to pay money to tear it down. All of the value is in the land. So that house that great grandma bought in $10,000 in Kerrisdale, Vancouver, which now, if it's still the same house, which is unlikely, but there might be one example of that, is worth $3 million or $2 million or something like that. It's all for the land, the lot. There's no value for the building. So if we tear down all those buildings and put a brand new building on top of that land, now you've got the land is very, very valuable, and the building is also very valuable. But the problem with the building being very valuable is the same thing that happened to great grandma's house for $10,000 is going to happen to the new building we're building today. It's going to go from whatever it's worth, $2 million worth of construction, to zero over the next 50 years. So that's depreciation. So the depreciation is going to happen over time, and the land value is going to go up over time. But we might be at the point, because it's so ridiculously valued in Canada, and there's no shortage of land, really, that the appreciation of the land is going to be slower than the depreciation of the brand new properties that have been built on top of it. So that means we won't see any net gain. We might even see a net decline for a decade or two in Canada, and that would be very difficult. We should have been out figuring out how to make electric cars, or how to build rocket ships, or how to do advertising on the internet like Google did, or
how about building giant air tankers to fight forest fires around the world? How about that?
That would have been great, given that half of BC goes up in flames every year.
And a quarter of Alberta, yeah.
I talked to, I was golfing recently in Mexico with a guy from Penticton, and he said that they have to look for a place to go in the summer to get away from Penticton because it's unbearable to live there in the summer in Penticton. So it's yeah, but even the tankers can't really fix that would take so much water to put out those fires, and there's no way that they could possibly do it, even if they had an unlimited number of tankers. So yeah, it's we needed to do something in Canada, and I think the government's tried to do it, but we were very busy doing other things. Most people saw the immediate profit opportunity in real estate, in oil and gas, in coal mining, for instance. And a lot of that stuff may have, maybe past its best before date. And now we got to find a new gig. Canadians need to find a new gig.
Are there benefits for people to sell their homes themselves versus using realtors?
Well, we did that once. We had in 2007, the real estate market in Edmonton was so hot, and we wanted to move, and we sold it ourselves. And it was like, I wouldn't really recommend it. It was not a pleasant experience, but it gets so emotional, right? And it happened, like these people kept coming back and saying, well, there's a deficiency here. We wanted to knock $10,000 off the price for this and $10,000 off for that. Well, if a realtor had been in between the two of us, the realtor would say, no, you can't do that. That's not going to, they would have discouraged them from doing it. But anyway, we got it done. But yeah, it's not a pleasant experience. But I do note, though, that Canada's real estate commissions are quite a bit higher than some other jurisdictions like the U.S., and there's a big lawsuit in the U.S. to get their real estate commissions down even lower because somebody's accused, I think the founders of RE/MAX are involved in this in the U.S. They're accused of collusion to artificially prop up real estate commissions. So there could be a big change coming there, and but the level of activity, I think the boom in Canada anyway, the boom is done, and now we're on the other side of it. So, bus, there aren't nearly as many real estate commissions to be earned anyway. So the big issue with real estate commissions and realtors is that there's way too many of them. At the current level of sales, there's not enough sales to keep even one realtor alive. Like one sale a year is not going to keep somebody, not going to pay their mortgage. So they're going to have to figure out how to shrink the size of the industry.
Are you going to get yourself a Tesla Cybertruck?
I'd love to have one. They look so cool. But I first saw it, I thought, that's ridiculous. I don't like the look of it. But now I'm sort of coming around to it. But I don't think it suits my... and I think I've given enough money to Tesla, actually, at the moment. I'm feeling because what's happened is Tesla's been reducing prices of their the new vehicles right now. So it hurts quite a bit. I bought my current one in 2021, and the price of that same vehicle, brand new, that I paid, what I paid compared to today is about, let me see here, it's about 30% lower today. And it's not even the same car, because knowing how Tesla works, in 2 years they would have improved the car in several ways, and so some of which they've given me through the over the air through the Wi-Fi software updates, but some of it's hardware which they can't give me. So it's pretty brutal, that process. So yeah, I understand that they put a clause in the Cybertruck. They can't make them fast enough. That you're required to hold on to it for a minimum of 1 year, because they don't want people buying them and then flipping them within a year for a higher price. So it's like we used to do in the stock market back in the good old days, when you get a hot new issue and people would flip it, and the issuers of the stock didn't want anybody flipping them, so they would try and stop them from flipping the stock. Of course, you can't stop them, but they tried to stop them. So yeah, I think it would be cool to drive. I don't know if it's suitable for the city, though. I don't know how that would work, but certainly would look good in the drive up to the golf course or something. Everybody would come around.
Edmonton bought $60 million worth of electric buses. Is it true they don't work well in cold weather?
I think they work fine in cold weather. It's just that they didn't have enough range on the batteries. So if you wanted to go to work, you're fine, but you just can't get home on the bus. No, I'm just kidding. Buses are ideal for battery because they've got all night to recharge. They generally aren't used much at nighttime. So, but this company Proterra, it's called, went bankrupt. So I think the issue was more that the company went bankrupt. And again, it might too be, partly early adopters sometimes don't get the best version of the vehicle it's going to be. There's one doing school buses called Lion Electric. School buses are great because they're used for a couple hours in the morning and a couple more hours in the afternoon. They can charge in between and stuff. But I think if it is a battery range issue, I think one of the ways to get around that is with swap. For cars, swapping batteries makes no sense because cars generally don't run the full size of the battery in one day. But some of these heavier duty vehicles, like highway trucks and city buses, they may need to look at swapping the batteries, but it'll work fine. I mean, it's just growing pains. It's like my first Tesla, which was 2016, versus the version that's out today. What's that? 7 years? It would soon to be 8 years. It's quite a bit of improvement in almost 8 years, and that'll be the same for those city buses as well.
Hilliard, where's the best place for people to follow you?
Well, I'm active on Twitter. Actually, it's interesting enough, I should say X, formerly known as Twitter. And, there's been a lot of negative stuff about Twitter recently, especially with people commenting on Hamas and Israel and stuff like that. But it's just amazing the stuff you find on there in terms of information that would take you hours to research. And you just sort of have to find the people to follow and then make a little circle of, can do lists and stuff. And And so I'm very active there. And then the call sign is HMACBE, just the letters HM, which is my first initial and then first part of my last name. And then also I publish a weekend note every week, and everybody's welcome to get a free copy of that just by sending us their email address. And if they don't want to do that, then they can just follow me on Twitter. And there's every Friday, it comes usually on Friday, there's a link to our website where you can get the article. And then at the website, you can register if you want to get it directly into your inbox.
Hilliard, thank you so much for being on This Week in Money.
You're welcome.
My guest has been Hilliard MacBeth, author of the second edition of the book, When the Bubble Burst, Surviving the Canadian Real Estate Crash. His website, MacBeth.Partners.com. He was speaking to us from Edmonton. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Victor Adair, and Hilliard MacBeth. And thank you for listening. If you have any questions for the show or for our guests, you can send them to info@howstreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at TalkDigitalNetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen.